Hello students, welcome to EPG Pathshala. I am Dr. Vishal from Maharaja Agarsen University, Badi, Himachal Pradesh. Today we are going to discuss about the module Lease Financing and Hire Purchase under the paper Tourism and Hospitality Entrepreneurship and Legal Environment. After completing this module, students, you will be able to understand meaning and definition of lease financing, kinds of leasing, basis or rationale for leasing, advantage and disadvantages of leasing. Also know about the concept of hire purchase, and you will be able to understand the difference between lease financing and hire purchase. Leasing is a technique of procuring the use of asset without buying it. It is a form of agreement between two parties, the leasing company or the lessor and the user or the lessee. The charges are set and payable at fixed intervals of time according to the common ease of both the parties. The ownership of assets rests with the lessor and does not get transferred to the leaseholder even after the expiry of the lease agreement period. Lease financing is based on the thought made by Donald B. Grant, why own a cow when the milk is so cheap? All you need is milk and not the cow. A lease agreement is a contract between two parties, the lessor and the lessee. The lessor is the legal owner of the asset, and the lessee obtains the right to use the asset in return for regular rental payments. The lessee also agrees to abide by various conditions regarding their use of the property or equipment. For example, a person leasing a car may agree that the car will only be used for personal use. The European Leasing Association defines leasing as a contract between a lessor and the lessee for the hire of a specific asset selected from a manufacturer or seller of such asset by the lessee. The lessee has possession and the use of the asset on payment of the specific charges over a period. The International Accounting Standards and Committee have defined a lease as an agreement whereby the lessor conveys to the lessee in return for rent the right to use an asset for an agreed period of time.
Elements of lease structure. A lease is different from a steady finance transaction. The important elements are the transaction. Under loans, what is rented out is money, whereas in lease, what is lent out is asset. So it is an asset renting transaction. Parties to a lease. There are two parties to an understanding of lease financing, in particular the proprietor and the client, called the lessor and the renter. Lessor and also the renter may be people, organizations, business entities, firms, or budgetary foundations, where the properties or a lot of funds is included. There might be joint lessors or joint tenants. There may likewise be a rent dealer who goes about as a middle person in orchestrating these arrangements. These rent representatives incorporate merchant banking divisions of outside banks in India, divisions of some Indian banks, and even some private trader investors. They charge a specific fee for their administration. The leased asset. The assets, properties, or equipment to be leased is the subject matter of the leased financing contract. The asset may be any tangible asset like an automobile, machine, land, building, factory, or a consumer durable. The asset must be leasee's choice, appropriate for his or her business needs. Lease period. It is essential to have a definite period of lease and should not lead to sale of an asset. The primary period is meant for recovering the investment of a lessor and is non-cancelable. The secondary period allows the lessee to use a considerable part of the remaining asset value and is cancelable. The lease may be continuous with an choice towards the end of the lease period to renew the lease for further period. Lease rentals. Lease rentals depend on the cost and risk borne by the lessor and include interest, depreciation, service charges, etc. Residual value. It means the worth of the rented asset at the end of the lease term. End of the term option. For termination of the lease, various ways are possible, namely, the lease is renewed on a non-stop basis or a positive period, or the asset comes back to the lessor, or the asset comes back to the lessor and the lessor trades it to the third party, or the lessor sells the asset to the lessee. This includes bargain buyout option, bargain renewal option, option to return equipment at the end of the lease term. Upfront payments. This includes instant payments from a lessee such as down payment, advance lease rental, security deposit and original fees. Kinds of lease agreement. Any lease agreement falls into one of the following lease financing, that is financial lease, operating lease, sale and lease back, leveraged lease and direct lease.
Financial lease. A financial lease, also known as capital lease, is a type of lease in which a finance company is typically the legal owner of the asset for the duration of the lease, while the lessee not just has operating control over the asset but also a substantial share of the economic risk and returns from the change in the valuation of the underlying asset. Operating lease. An operating lease is a lease whose term is short compared to the useful life of the asset or piece of equipment being leased. It is commonly used to acquire equipment on a relatively short-term basis. At the end of the operating lease, the lessee has several possibilities: pursuit of the lease, return of the equipment, renewal of equipment, restoration of equipment, purchase of equipment at their market value. Domestic lease. In this, all the parties to the contract, namely lessor and the lessee equipment supplier, are domicile of one country.
International lease. If the parties to the lease business belong to different countries, it is known as international lease. Import lease. The lessor and the lessee are from the same country but the equipment supplies is placed in a different country. The lessor imports the assets and leases it to the lessee. Cross-border lease. The domicile of supplier is immaterial here, and the lessor and the lessee are placed in diverse countries. Sale and leaseback. In this, the assets are not actually exchanged but remains in record on paper only. The owner of an asset sells the asset to a party who in turn leases back the same asset to the owner in reflection of lease rentals. For example, land which are not subjected to depreciation. The lessee, if dissatisfied with the asset after possession, can convert the sale into a lease agreement. Leveraged lease. There are three parties in these types of lease financing: the lessor, the lessee, and a third party. It is used for financing those assets which need huge funds. Such assets include aircraft, railway equipments, oil rigs, etc. The lessor obtains the assets as per the terms of the lease contract but finances only a part of the investment, say 25%, and the third party lender provides the balance of the financing. The money lender is paid off from the lease rentals straight by the lessee, and the excess goes to the lessor. The lessor, the owner of the asset, is authorized to decrease allowance with the asset. Direct lease. A firm acquires the privilege to utilize an asset from the manufacturer straight, and the proprietorship stays with the maker. The direct lessor includes manufacturers, finance companies, independent lease companies, special purpose lease companies, etc. Bipartite lease has two parties, namely equipment seller cum lessor and the lessee. Tripartite lease has three parties, namely equipment supplier, lessor, and lessee. Basis or rationale of leasing. Convenience. Whenever a company needs equipment for short period, it can buy one and sell it after use. This involves a lot of effort, time, and cost. So the other alternative is to lease it for a short period rather than buy it. Benefits of standardization. Leasing can be a cheaper source of finance as standardized contract can be used without incurring a large administrative and investigative cost. Better utilization of tax shield. The tax benefit of asset ownership may vary across various units in the economy. This may be due to differences in tax or differences in the level of income. A firm that does not have an asset cannot avail tax benefits. These firms may share a part of that benefit in the form of lower lease rentals from a firm that enjoys tax benefits in full. Fewer restrictive covenants. Lease contracts contain fewer and less restrictive covenants. On the other hand, term loans have several restrictive covenants. Lower cost of obsolescence risk. The lessor, in order to beat the risk of obsolescence, enhances the lease rental. In effect, the lessee bears the cost of obsolescence risk. This risk can be reduced if the lessor, with better access to potential users of assets, may be able to find an economic use of obsolescent asset and thus reduce the economic cost of obsolescence. Quick implementation. Leasing facilitates quick implementation of a project and thus reduces cost and provides some competitive edge. Matching of lease rentals to cash flow capabilities. For example, stepped up lease rentals are suitable for firms which are likely to experience a gradual increase in their revenues over a period of time. On the other hand, if a firm has long gestation period, deferred lease rentals are good. Mechanics process of leasing. A manager who does the work of leasing should be aware of the following mechanism of leasing. Legal aspects of leasing. It is the duty of the lessor to deliver the asset to the lessee and legally permit the lessee to use the asset. The lessee is indebted to pay the lease rentals as per the lease arrangements and protect the lessor's title.
Process of lease. The lessee selects the equipment. This involves clear specification of the equipment, supplier, price, and terms of warranties, guarantees, delivery period, installation, and service. The lessee submits an application to the lessor and negotiates the terms of lease. The lessee and the lessor signs the lease agreement. The lessee assigns purchase rights to the lessor and the lessor buys the equipment and delivery is made to the lessee. Sales tax provisions pertaining to leasing. The lessor is not entitled for the concessional rate of central sales tax on the ground that the asset bought for renting is meant neither for resale nor for use in manufacture. The 46th Amendment Act has brought lease transactions under the purview of sale and empowered the central and state governments to impose sales tax on the lease transaction.
Income tax provisions relating to leasing. The depreciation can be demanded by the lessor and not the lessee. The lease rentals acknowledged by the lessor are taxable under the head of profits and gains of business or profession. The lease rentals paid by the lessee are tax deductible expenditure for the lessee. Accounting treatment of leasing. Operating leases are capitalized in the books of the lessor. Lease payments are treated as income of the lessor and expense of the lessee. Finance leases must be capitalized in the books of lessee.
Let's discuss now the contents of a lease agreement. These relate to the legal rights and obligations of the lessor and the lessee. Description of the lessor, lessee and the equipment, amount, time and place of lease rental payments, lessee's responsibility for taking delivery and possession of the leased equipment, lessee's responsibility for maintenance, repairs, registration, etc. and the lessor are right in case of default by the lessee. Insurance to be taken by the lessee on behalf of the lessor. Change in lease rentals due to change in bank interest rates, depreciation rates and fiscal incentives, etc. Option of lease renewal for the lessee. Return of equipment on expiry of the lease period and arbitration procedure in the event of the dispute.
Factors that led to the growth of Indian leasing. No entry barrier, fast growth in car market, tax motivations and optimistic capital markets. Advantages of leasing. Saving of capital that can be used for buying of inventories. Elasticity and ease as The lease contract can be tailor-made as per the requirement of the leasee. Lease financing helps in planning cash flows as rentals can be paid from the money recovered by using the same asset. Leasing sales and lease back technique helps in improving the liquidity. Lease payments are considered expenses when calculating taxable profit expense when computing taxable profit at the end of applicable tax accounting period. Disadvantages of leasing: restriction on use of equipment as alteration of asset is not possible. Since ownership remains with the lessor, there is a loss of residual value. Sales tax can lead to double taxation. A net lease may shift the cost of repairs into the tenant. If any change in business, if required, it cannot be done before the end of the term. Let's discuss now hire purchase. Hire purchase is an agreement between two parties, hire vendor who gives supply of goods to the buyer called hire purchaser who pays the rate in installments. Till the last installment paid, the ownership of the goods will remain with the hire vendor. The amount of installments paid is the hire charges for the use of goods during that period, and so it is called hire purchase. Definition: according to the Hire Purchase Act of 1972, hire purchase agreement means an agreement under which goods are let on hire and under which the hirer has an option to purchase them in accordance with the terms of the agreement, and includes an agreement under which possession of goods is delivered by the owner thereof to a person on condition that such persons pays the agreed amount in periodical installments. The property in the goods is to pass to such person on the payment of the last of such installments. Such person has a right to terminate the agreement at any time before the property so passes. Hire purchase agreement. The written agreement should be signed by both the parties. The contract must contain account of the goods, hire purchase value of the goods, the date of start of agreement, the quantity of commencement of agreement, the number of payments, amount and due amount. Rights of a hirer: to buy the goods at any time by giving notice to the owner and paying the balance of the hire purchase price less a rebate. To return the goods to the owner on payment of penalty or reflect the owner's loss of profit and the fact that the owner now has possession of an obsolescent asset of reduced value. With the consent of the owner, to assign both the benefit and the burden of the contract to a third person. Where the owner wrongfully repossesses the goods, the hirer has the right to claim for compensation.
Owner's rights. The owner usually has the right to terminate the agreement where the hirer breaches any of the terms in the agreement. This entitles the owner to forfeit the deposit, to retain the installments already paid and recovered the balance due, to repossess the goods, to claim damages for any loss suffered.
Let's discuss now difference between leasing and hire purchase. On the basis of possession of asset, possession lies with the lessor and lessee has the right to use the equipment in case of leasing, whereas the hirer has the option to purchase instantly after the last installment is paid. On the basis of depreciation, the depreciation is demanded as an expense in the books of lessor. The depreciation claims is permitted to the hirer in case of hire purchase. Rental payments. The rent payment covers the cost of using an asset over the asset life, whereas in case of hire purchase, the installment is include the principal amount and the interest for the time period the asset is utilized. Period. Lease agreement is for bigger assets like land, property, etc., and for a longer time. Hire purchase include cheaper assets like car, machinery, etc., and are mostly for a shorter duration. Tax impact. The total lease rentals are shown as the expenses by the lessee for tax purposes. The hirer claims the depreciation of asset as expenditure. Repairs and maintenance. Repairs and maintenance of the asset depends on the type of lease. For example, in financial lease, it is the duty of the lessee, but in operating lease, it is the duty of the lessor. In hire purchase, the obligation lies with the hirer. The scope of financing. Under lease financing, no down payment are required can be called complete financing option. In case of hire purchase, normally 20 to 25% margin money is essential to be paid by the hirer. This is also called partial finance like loans.
So students, let's now summarize what we have learned in this module. In this module, we have discussed the meaning, features, and types of lease agreements. Although leasing business has been growing very fast, but recently there has been a shift to hire purchase as a popular means of financing asset to the entrepreneurs. Many entrepreneurs prefer hire purchase because of flexibility in terminating a hire purchase contract as compared to leasing contract. Hire purchase transactions benefits all parties involved in it. A vendor can easily make use of costly machinery, equipment, etc. without making full payment on the date of the agreement. The hire purchaser also acquires ownership of the goods after paying the last installment. However, the Indian leasing sector is reviving with the growth in economy, infrastructural developments, and many new entrants into the market. Lease financing is an alternative funding option and being used by all the companies. India's earth moving and construction equipment have the potential up to grow 60 times by 2020, and leasing models will play its role in this growth. Thank you very much.